So almost half of. So maybe the ones who are not invested in the market, they can stay back, and the others can go for a stroll. Because if you had invested in the market, then I'm sure you know the pains and gains of the market. But many years ago, when my son was still a small child, he asked me one day, Papa, every market has, shops and people, etc., but stock market has only animals. I only hear of bulls and bears. This is the market of the animals. I said, yes, a good point. Yes, either you are a bull or a bear. That's the only description of an investor in the markets. But gradually, as I also grew and I started understanding the market more and was fortunate to also be on the other side of the market, which is the regulatory side of the market, and interact substantially with investors across the country, having done hundreds of investor conferences. And being seen by investors at large as somebody who could help them, I realized finally that majority of the investors in India are actually neither bull nor bear. They are a third species, which is the monkeys. They only ape others. They don't apply their mind. They just follow a tip. They follow market herd mentality, and they become monkeys, and they become the third species. And sooner than later, the same third species gets converted into the fourth species, which is the donkeys. Because ultimately, small investors, by and large, tend to not make money in the markets, and which is a combination of factors, which is lack of financial knowledge, financial literacy, and the markets being so advanced and so intelligent that they really know how to. If somebody makes money, somebody has to lose money. And we have this whole wide, intelligent population of investors who would devise products, services, and systems to ensure that the small investors keep coming to the market and majority of them lose money. And one of the problems of financial literacy or lack of financial literacy is that small investors who somehow learn or even aim to enter the market. They enter the market, but very few know how to exit the market. And that's where most of the people lose money. Because when they have invested in a particular stock, for example, and the markets are rising, then they get to believe that, why should I sell today? The markets are rising, my own stock is going up, and we're fool to sell out today. And they keep holding on. And when the markets are going down, they believe that the markets would come back to their heights. Why should they do this? A stock that had gone to 100 rupees is now come to 85. It will come back to 100 or maybe more, and I'll sell it that time. And the stock keeps losing price ultimately. So the best example of this that I give is of my own father-in-law. He never invested in the stock market, and he thought that most of the money I made was in the stock market, which was not true. But I let him live in that illusion that I am a very expert stock market investor. So he would ask me, one day he asked me, आपने बहुत पैसा मिला, कुछ मेरे को एडवाइस नहीं देगा, ऐसा मैं किसी को एडवाइस नहीं देगा. Because market के अंदर one thing that I realized is that you should give an advice on a particular stock. If the person makes money, it is because of his luck, his intelligence, his foresight. If he loses money, then it's because of him. So there is no one ever giving an advice. So that's the reason I am not giving any advice. So if you are a very expert, you invest regularly in IPO, so give me one or two tips in the future. Around that time, a company called First Leasing was coming with an IPO. And it was coming at par, and the company was already in business, and I thought it was a good investment opportunity, so I called him up. He lives in Agra. I called him and I said, ये issue आ रहा है, I'm applying for toll gate shares. आप भी apply करते हैं. Thank you very much. And then I came to know that he had applied for 5,000 shares, not toll gate shares. And since leasing was not a very hot subject, we got almost the full amount. Now, whenever I entered the market, I used to actually decide on an exit strategy on the day of investing. which is that in case, depending on the year and my own need, I would say that if the stock reaches 30% plus, I would sell. I will not wait for, somebody else has to make money also. I cannot maximize the market's profits. I made my 30%, somebody is buying now at a price higher, let him, reap the benefits of it all. You cannot maximize the return. So in this case, I think I must have set an exit price of 30% plus. And I called him that and I said, I'm selling out my 200 shares and you may like to sell up. He नहीं आप क्या करते हो? बिल्कुल बढ़ रहा है, 2-3 महीने हुए हैं. The stock went to 40, 50, 60, 70 rupees, and he would almost ridicule me by saying, देखिए आपने तो बेच दिया 30 रुपए के अंदर, अब 70 रुपए हो गया. मैं साफ बेच दी. नहीं अभी तो मार्केट ऊपर जा रहा है. The stock went to 100 rupees, 110 rupees. And then something happened to the company and the prices started falling down. And finally it reached 100. He had still not sold a single share. And when it was falling, I called him a couple of times, sir, अब तो कुछ दे दीजिए, at least recover your investment. आधा दे दीजिए. He would not sell it. And the stock fell down. And one day when I was visiting him, he asked me, क्या करूँगा मैं शेयर पे? मैंने कहा साहब आप रजिस्टर में उसका नाम हटा. Because every time you open your register every morning, you look at the page and you feel sorry, you start your day very badly. तो आपको उसको हटा दो, उसके शेयर सर्टिफिकेट में हमारे में डिमांड नहीं होता था. तो शेयर सर्टिफिकेट का बंडल बांध के लॉक कर देंगे ताकि आप उनको देखोगे. I don't know whether he followed my advice or not, but he stopped talking about that share. One fine day in '92, a news came that Mr. Harshad Mehta had acquired the company. Why Harshad Mehta was, I don't know how many of you know, but he was the first real king of the Dalal Street. Harshad Mehta ने जब वो company खरीदी, the share on that very day went from 1 rupee to 20 rupees, and next day it was at 80 rupees, and then it went to 300 rupees. And since, my father-in-law was still holding 5,000 shares, I told him, sir, आपके को बहुत मजे हो गए, 15 लाख के शेयर बिकेंगे, आप भेज दीजिए. अरे नहीं हर्षद मेहता ने खरीदे, अब तो क्या मतलब. अब तो ये सब कह रहे हैं कि 2000 जाएगा, 3000 जाएगा. The share actually went to 2,000 rupees in a matter of 15-20 days. And then he stayed there, and he would enjoy the profits on paper, not money in the bank. And one day the Harshad Mehta scam happened. And the stock went back to 1. And he still had all the 5,000 shares. And he passed away a year ago, still holding those 5,000 shares. So exiting, the point, the reason I am telling you this story is that greed and fear, these are two very important characteristics of the capital market. And when either of them overtakes you, then you are a bad investor. My own journey in the capital market started when Mr. George Fernandez, when the Janata government was formed in 1977. He was a maverick minister. And one of the very good things he did for the Indian capital market was to come out with one policy, which was to say that every single foreign company operating in India will have to offer 49% of its share capital to the Indian public at large, retail investors. There was a lot of opposition, companies like Coke and Pepsi and IBM, and you had hundreds of pharma companies. But government is government, and he issued the orders. And one of the very first company which entered the market under the FERA dilution scheme IPO that they are called was a company called Ponds India Limited. Ponds still makes cream, one of the most famous products. It's now been acquired by Hindustan Lever, so that company per se does not exist. But so I saw a very small, tender kind of an ad in Hindustan Times of this public issue of Ponds India shares. थोड़ी knowledge तो थी, having done MBA, so I understood something about. I am not invested in this, but I saw this ad and I saw the price of the share. The issue price was 20 rupees a share. And there was a profit and loss statement in summary which was given in the ad. And I looked at the numbers and I said, 20 rupees, this is definitely a throw. I mean, this is a gold mine. I was a service employee, just managing to live life comfortably, no money to invest. For even 100 share application, you require 2,000 rupees. There was a lot of money saved. I somehow pulled out some of my resources, took a loan, small loan from my employer, and put it in an application of 100 shares. And then I said, मैंने शादी में my father-in-law kept insisting कि कुछ तो आप लीजिए. मैंने कहा आप बेटी मैरिज कराओ कुछ नहीं चाहिए, नहीं आपको कुछ तो लेना चाहिए. तो उस समय मैंने obviously I did not have any of his gifts or anything. So I called him one day and I said कि साहब आप बहुत पीछे पड़े हो तो आप 2,000 रुपये का लोन दे दीजिए, वो भी बेटी के नाम दे दीजिए. तो क्या करेंगे आप? मैंने कॉल करके इसको आगे मैं सुविधा अप्लाई करना था. So he immediately sent a DD and then so we put in two applications, 100 shares each. And since it was the very first issue, itni aag lagi हुई थी बाजार में, so I got full lot. The rest is history. About 300 companies came to the market. Within 3-4 months, everybody knew. Then Quant India got listed. Then Quant India got listed 2.5 months later. Nowadays, companies list within 5 days of the IPO. In those days, it used to take almost 3 months. When the company got listed, the opening price of the share was 130 rupees. At 20 rupee investment, 130 rupees opening price. Obviously, it drew attention, and every single fair issue which came was hugely oversubscribed. It became a pure lottery. You would apply and just hope that you will get some shares. Otherwise, 90% of the people would get full orders. And the Quant India investment of 4,000 rupees, when I finally liquidated that, it was to buy my first apartment, where I still live, for 16 lakh rupees. A 4,000 rupees investment became 16 lakh rupees. That is the power of capital market. That was one of the few stocks that I held on for a long period, and storytelling will continue. Let me start off with the presentation. So let's talk about the securities market. So I'm going to be slightly, school teacher try to give you very basic knowledge, assuming that a lot of you have not known anything about the capital market. I may be slightly advanced in certain areas, but I'll be very happy to answer questions while I'm speaking. So if you have any questions, you want to understand anything, just raise your hand. I'll be very happy to do that. Now, as you all know, securities market is regulated by SEBI, Securities and Exchange Board of India. SEBI was set up in 1992 by Mr. Manmohan Singh in his first liberalization speech. Until that time, there was no regulation of the capital market in India. There was only a regulation of the issuances, that is, all new issues had to be approved by an office called the Controller of Capital Issues in the Ministry of Finance. And their job was also not to look at anything else except the price which you were planning the IPO. Besides that, there was no regulation. Secondary market regulations were almost non-existent. Each stock exchange used to run their fair terms in a sense that they could get away with literally with murder. But in 1992, SEBI was set up, quite like SEC or other regulatory organizations across the world. Now, let me start from the very, very beginning. What is capital market? What is securities market? So when you start, when anybody wants to start a business, obviously one of the important things you require besides the idea, the product, etc., is capital. So you need money to buy equipment, space, hire people, you need working capital. So capital is an important part of starting a business. Now typically, what are the sources of this capital for the initial stages? So many people will start with their own money. If they have some savings, they will put together their savings and start a business. If the money requirement is slightly larger, they could go to their family or their friends or neighbors and borrow some money or get them to invest into the company through liquid capital. also go to banks for loans, but loans are typically available only against fixed assets. Banks typically would not lend for an idea or for working capital loan. They would require a project, and a project for them would typically mean hardcore building, plant machinery, and other equipment. But if you're looking at equity capital, then there is a whole body of what we call as angel investors. These are people who have made money in their life, and they like to promote ideas, and they like to give capital to startup ideas. There are hundreds of angel investors now in India and abroad, and an investor entrepreneur could typically look at reaching out to one of the angel investors, selling his idea to him, and getting some capital to start or to expand the business. And once your business grows and you require more money, then there are what is called as venture capital. The other term for venture capital, which is also used, is private equity. These are monies available with very rich individuals who like to invest in companies at various stages, startup, growth, or even advanced, later stage of the company. And venture capital firms or PE firms typically look at larger investments. There are some firms that do not invest anything less than 50 crores in a company. There are venture funds who will invest 1 crore, 50 lakhs. So you have a range of venture capital firms and PE firms who would be willing to give capital to a startup project or a growth project. Now, that's the private part of the market where you are not really engaged with the public at large. But the public markets are the most critical part of any economy. They are the engines of growth because they help mobilize savings from households and put them into productive use through raising equity capital. And this capital is typically raised through what is called an IPO. And that's a subject that I was given to speak on today. So I'll spend some more time, a lot of time on telling you about IPOs and the whole process and the key terminology which are used in IPOs. Now the capital market is typically divided into two parts. One is called the primary market. The other is called the secondary market. Primary market is a market which is a market for raising of capital. Secondary market is a market which is for trading of that capital. So it provides a platform where you can sell shares or buy shares. So there is a primary market and then there is a secondary market. Now, as you all know, probably IPO stands for initial public offer, which basically means this is the very first time in a company's life when it goes to public at large to raise capital. The very first time. In case it has already raised money from the public, it will not be recognized. The very first time a company goes, an unlisted company, a company which is not listed, then it goes to the market to raise money from public at large. It's called initial public offering. Now IPO can be done for, primarily it's done for raising capital. You are growing, you are expanding, you are diversifying, you need more capital. So you go to the market and get investors to put in their money. But IPO can also be done for several other reasons. So you can have an IPO where the private equity or venture capital investors will put money into your company. Now they want to get out because they all have a life. All venture funds have a life of 5 to 7 years. And the investment they make, they have to encash those investments. And one of the important rules used by venture capital funds and PE firms is to sell their shares once they are listed in the market. And they can also sell their shares when the company is getting listed in the market. So you will find a lot of IPOs where there are also IPOs where no money is being raised for the company. The company does not require any money. It's got enough reserves, enough internal accruals to grow. The entire IPO is basically to facilitate exit by an existing private equity investor or the venture capital investor. So he wants to sell off his shares and he offers his shares through the IPO route to public at large. And that's called an offer for sale. There is no fresh capital being raised, it is entirely an offer for sale. There could be IPOs which have a combination. There could be some money which is being raised for the company for its growth and expansion, and some money could be raised, to allow venture capital investors to sell out. So it could be a combination of fresh capital and an offer for sale. There are companies, some companies who do not require capital. They have self-funding, they have huge profits. They have no venture capital investor who wants to exit, but they want public branding because listing gives you also a lot of visibility. It is, you're written about in newspaper, in media, there are discussions, debates happening on television channels. You get a lot of free publicity, a lot of brand awareness once you get listed. And there have been some companies who have gone for an IPO only because they wanted to improve their public image and branding. Creating a currency for the promoters. Now here, when a company is unlisted, you can have several views on its value. There are many ways of valuing a company, and two persons can have a totally independent and different view on the valuation of a particular company. The listing provides you with a firm valuation, a market valuation, that cannot be contested. Any other valuation can be contested. Because valuation ultimately is in the eyes of the buyer. Because he finds the price okay, and a same asset we've seen can be sold by value by someone, even the biggest expert for 100 crores, and another valuer can put a price of 200 crores on that asset. A third buyer can put a value of 300 crores, depending on what value is seen in that company and what value we can derive in future from that company. But public market will give you a minute-to-minute market validated valuation of the enterprise. And once you get that valuation, then the shares of that shares become currency. If the promoter is holding 75% of the equity, he can sell 2%, 5%, 6% in the market and raise money. He can use those shares to do a swap, which means he does not have to, if he wants to buy a company, he doesn't have to shell out cash. He can transfer his shares to the owners of the other enterprise, make him a shareholder in this company, and not do a cash transaction at all. So shares can be used for acquiring entities. And finally, wealth accumulation. Most lists that you find across the world of the wealthiest people are calculated by the wealth that is in public domain. If I got thousands of crores lying in cash under my bed, nobody will value that because nobody knows about it. So wealth evaluation is typically done by publicly known sources that you have of wealth. And one of the most trusted and most recognized method of valuation is the wealth that you have in terms of shares that you own. So if I am the